now. So this session is going to be recorded and it would be provided for you to watch all over again. So do you guys have any question? So if you have any question, simply put it in the chat. I will answer them. We'll be starting in about 2 minutes from now. Okay, so in the absence of no question, Titilope, can you please start your class?
Okay. Thank you.
Hello, Titi, are you there?
Yes, I am. I'm here. I'll start sharing my screen again. Okay. Okay. Good morning, everybody. Good morning, everybody, and you're welcome to the Principles of Auditing class in this slide. Yeah, you're welcome. So I am Titilope James. I'm an auditor at PJF Professional, and I'm a child accountant as well. So it's good to have you in the class. I hope you have a good time. So before we proceed, I'd like to give you a little bit of insight into what you should expect. Okay, into some insight as to what you should expect in the audit as a course. So a lot of people get bored because they feel like it's too much of reading, it's not interesting and stuff. But then I don't want you to go in with that mindset, because audit is very interesting, especially for people who like to question, who like to know why things happen. So I want you to approach audit with that open mind. Try your best to, aside from listening to what I'm going to be explaining here, study your study part. Let's go through your study part, because it's going to give you a lot more insight to some of the things that I'm going to be explaining. So that's it. Let's get into the class. So we'll be looking at introduction, historical background of auditing, how auditing is today, the definition of audit, the purpose of an audit, the objective and general principles governing an audit of financial statements, then the objective of audit as well, then the scope of audit, what should be covered in an audit, reasonable assurance, auditing and materiality, the responsibility for financial statements, advantages, disadvantages, limitations of audit, expectation gap, conclusion, and some more. Okay, so introduction to auditing. So we'll be going in an informative format, and I'm going to be explaining. So I'll speak to the slide and we'll continue from there. So audit is a very demanding task that requires competence, integrity, skills, experience, technical knowledge.
You can't see your screen. Can you please share your screen, please?
Oh, you can't see it. Wow, I thought I was sharing my screen. I'm coming. What's going on? Sorry about that. I thought I was already sharing. Can you now?
Yes. And please put it on full screen.
Okay.
Yeah, that's good. Thank you.
So sorry about that, but they heard me, right? Did you hear me?
Yeah, and please be a bit audible also.
Okay, can you hear me now?
Your voice- Yeah, we can.
Okay. So wait, do I start from the beginning? Like you didn't hear me at all
Okay.
at the beginning.
Yeah, but your voice is kind of low. Can you please
Start again.
be yeah? If you are using a mic, put the if you are using answering, put the mic close to your mouth.
Okay. So let me start again. Good morning, everybody. You're
Okay.
welcome to the Institute of Auditing, Part 1. I'm Titilope James. I'm an auditor at PKF Professional, and I'll be taking you through auditing. So you're welcome to the class. And as I said earlier, approach auditing with a open mind, be ready to read. It's very interesting actually. As I explained to you, and when you go back to study, you have a better understanding of what auditing is about and you want to read it more. But please don't discount studying your audit part because of this class. Thank you. Um, so this is our outline. We'll be looking at the introduction into auditing, how auditing started, that historical background of auditing, how auditing is today, the definition of audit, the purpose of an audit, the objective of an audit, the scope of an audit, reasonable assurance, auditing and materiality, who's responsible for the financial statement preparation, the advantages of an audit, disadvantages as well of an audit, the limitations of auditing, and the gaps in auditing. Then we're going to conclude. So, auditing is a task that requires competence, integrity, skills, experience, technical knowledge before you can actually perform it because you have to be relying on a lot of standards before you can conduct an audit. Not everybody can just go into auditing. You have to be trained on how to go about the auditing. And that's why you are in this class to go through the whole ICAN to give you an insight when you get into the field. So the responsibility of an auditor is simply to gather sufficient and appropriate evidence to enable them make informed judgments about a whole business situation. This can be best achieved if the auditors understand how organization operates and the environment in which they operate. So let me simplify this. So audit basically is about um, independent auditors going into an organization to examine their financial statements. And now you know financial statements are the statement of profit or loss, the statement of financial position, statement of change in equity, the note to the account, basically, and the statement of cash flow. So the auditors are going in to examine everything they have done to bring about that financial position, financial statement, basically. So like, are the figures correct? Are they properly classified following the International Financial Reporting Standard, which is the regulatory standard for financial accounting? And are there proper authorization? Is the control system proper? Can people place reliance on the financial statement? Is there need for adjusting some figures, correcting some things? So that's the work of an audit. We look more into that as we get into the audit. That's more of like the practical aspect of what auditing is about. But basically, the objective of auditing or the work of an auditor is just to gather sufficient evidence on the information provided in the financial statement to be sure that there's no material misstatement. Now, when one key thing I want you to know when you are studying definition is for you to actually highlight the keyword, like me saying material, sufficient, appropriate evidence. All these things will be explained later to you. But then these are key components for you to understand when it comes to auditing, so you don't just cram what auditing is. So the issue of auditing started in the olden days when auditors were they were not called auditors at that time, but individuals were um put on the job to check what the tax collectors were doing. And then also in Britain, when independent persons were employed to ensure that the tenant farmers were reflecting the right revenue received from the estate. So basically, they were just to check that their landlord or their lords were not being cheated, and also the tax collectors to check that they are reflecting the right amount. Okay, now auditing today is quite deeper than that, because it's not only about um checking for correctness, or because the truth is, okay, we'll look more into the concept. You can't check 100%. So basically, auditing is more of a judgment based um job that requires skills, professional expertise, experience, as I said earlier during the introduction. But let's read this. So auditing today is deeply rooted in the concept of separation of ownership from management, the affairs of the company, i.e., that's the agency theory. Now, there wouldn't have been need for an audit if there was no separation of ownership from management. Now, and as I said, it's called the agency theory. What happens is, the shareholders start a business, and then they hand over the management to who we call the board of directors. And we as auditors have to come in to check that the directors manage the funds or the resources of the shareholders to achieve their objective, which is profit maximization, and that they are not being cheated. So that's where the agency theory comes in. That is separation of ownership from management. That is, the shareholders are now different from the board of directors. So now audit now comes in to safeguard the interest of the owners, that's the shareholders, as I said, to show or to help them confirm or verify that the management are not cheating them or are not mismanaging the resources that they have put in their care, since the shareholders, that's the owners, are not involved in the day-to-day operations of the business. So the account of stewardship. Now, the directors are called stewards. The directors are called stewards, and they are to give account, and that account is done through the financial statement, as we know. And now, the account of stewardship within the context of a company is how the directors have dealt with the investment of the assets of the company on behalf of the shareholders, and the end product of the shareholders of the stewardship being the financial statement, profit or loss, balance sheet, cash flow statement. Although we don't have value added statement anymore, director's report. Yes. So an auditor should be a member of a recognized professional accountancy body and duly licensed to practice, and not disqualified by any legislation. So before you can be an auditor, of course, you have to go through this whole professional body, that's ICAN, and which is why you are also here. Someone without this knowledge of auditing that you are going through now cannot just wake up one day and say, I want to become an auditor, because auditing is regulated. So an auditor is expected to express an opinion, keyword opinion, on the truth and the fairness of the profit or loss account. Now, note opinion, truth, and fairness, because these are keywords that you need to understand what an auditing is basically about. Of the profit or loss account, balance sheet, of both of which will be prepared by the directors and presented to the shareholders at an annual general meeting. Now, as we said, the directors are the stewards. They are the one responsible for preparing the financial statement. An auditor just comes in to examine all that they are prepared, obtain evidence that the figure that they're reflecting in the financial statement is true and fair, and be sure that there's no material misstatement in that particular financial statement. That's the work of an auditor, just to express an opinion on those financial statements prepared by directors. Okay, now proper definition of an audit. Auditing is defined as a process carried out by an appointed qualified person. Note everything I highlighted that I made bold. Qualified person or body, whereby the records and financial statements of an entity are subject to independent examination in such detail as will enable the auditor to form an opinion as to their truth and fairness. So before an auditor can form an opinion, he would have done an independent examination of the records and the financial statements. And of course, the auditor has to be a qualified person, not just a qualified person, he has to be appointed. He has to be appointed as the auditor of that company by the directors. Okay, so let's move on. We'll be explaining this. Okay, so why is there need for an audit? Okay, why is there need for an audit? It still goes back to my explanation on the agency theory, the fact that the shareholders are different from the owner, from the managers of the business, and the owners want to be confident that they are not being cheated, that the reports provided by the stewards are actually what they should be, and that they are managing their assets properly. Okay, so um sorry about that. I want to explain the definition of that audit. Hold on. Okay, let's continue from here. So as I said, I was going to explain the key word, the key concept in the definition of an audit. First of all is qualified person or body. So for a person to be appointed as an auditor, first of all, you have to be certified as a qualified accountant. That is, you are expected to have gone through ICAN, expected to have gone through professional training. You are not a newbie when it comes to auditing standards or financial reporting standards, that you have been properly trained on auditing, you properly trained on corporate governance, you properly trained on
Hi, Titi.
ethics.
Yeah, sorry
Yeah.
for interrupting you. Please off your video since it's not showing. Your camera.
Okay.
Yeah, kindly turn it off since it's not showing.
Was it affecting anything? Oh, they're seeing blank.
Yeah, yeah. So I think we want to focus on the slide, so you need to turn it off.
Okay, I've done that already.
All right, thank you.
Okay, so as I was explaining the keyword in this definition, appointed qualified person. A qualified person is one that that we have the expectation to have gone through a professional body, certified by a professional body, to be knowledgeable on accounting standards, on auditing standards, on ethics, on corporate governance. And records and financial statements are basically the statement of financial position, statement of profit or loss, cash flow, the notes to the account, statement of changes in equity as well. Those are what gives a report on the performance of the management, basically performance of the company, how the managers, that the directors, are manage the resources of the shareholders. And then independent examination. So now, and before you an auditor is expected to express an opinion, he can't express an opinion if he's not independent, because first of all, the shareholders are relying on the auditor to get that confidence that the financial statement presents what it should present. Now, if they are relying on the auditors are expected to be independent in the sense that they are not supposed to be biased, they're not supposed to be um, influenced by the directors. They are supposed to be independent of the directors, independent both in action and also in mind. We'll look more into that as we get into the audit in detail, but this is just the introduction basically of what we'll be looking in deeply as we go on. And also, the auditor is to form an opinion. It is just an opinion based on his professional judgment. And as you go further, you see the reason why it's an opinion. It's not a statement of fact that your account is free from misstatement. No, it is an opinion based on their judgment, based on their expertise, based on the procedures that they have conducted. which is subjective, which is subject to a lot of things, subjective and not exactly objective. We look further into that. And then truth and fairness, basically truth, they are presenting the right figures, fairness, that they are done according to the expected standard, which is IFRS, that we all use, which is IFRS. So that's what truth and fairness actually represent. We look further into that as we go into the audio. Okay, the objective of an audit. The objective of an audit of financial statements is to enable the auditor express an opinion. That's still a keyword. You have to note that if there's anything you must remember all these keywords when it comes to auditing. Opinion, 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 express an opinion. Whether the financial statements are prepared in all material respect in accordance with an identified financial reporting framework, which is IFRS, and that the financial statement gives a true and fair view, or present fairly in all material respect. These are in quotations because these are the terms you are going to see in audit reports. If they present a true and fair view, or they are presented fairly in all material respect. You see a lot of these terms if you go through an audit report, the financial report and state of affairs of the client entity. So as an auditor, you are dealing with a client, we call them clients. Now the subjective objective, which is the secondary objective, the primary objective is to express an opinion on the financial statement, while the secondary objective, which are the things that get achieved while in that audit process, are to detect errors and fraud. That is not the primary objective of an audit. It's just something that happens while the audit is going on. Because as you are conducting your audit processes on the financial statement, you may identify some fraud, which is difficult. That you see more of that in your finals. You may identify some fraud, you may identify some errors, and you may also not identify some errors and fraud. That is not your objective anyway. But then if you have a very good, depending on the audit risk of that particular audit engagement, you may detect errors and fraud depending. So more reason why you should note that auditing is basically about giving an opinion, expressing an opinion, and giving reasonable assurance. To look more into that. That is not a fact, because you can't detect all the errors, you can't detect all the fraud in a financial statement. You may not even detect at all. And also, a secondary objective is to prevent errors and fraud. So a lot of management, so when they hear that auditors are coming, there's usually that fear, they're going to identify something in the financial statement, and they don't want to have issues with their shareholders. So there's that fear that we are going to be checked. It's different from when you are just working and nobody is checking the work you are doing. When you know that you are going to be reviewed, you are going to be thoroughly evaluated, your books of accounts will be checked, your controls will be checked, and everything. They're usually uptight to ensure that the financial statements are properly done. And on the flip side, they're also uptight to be sure that they try to maneuver whatever they want to maneuver in a very intelligent way. So, but then auditing secondarily prevents fraud and error because of that belief that, oh, they're going to identify something, we don't want them to see errors in our accounts, we don't want to be maybe penalized for an error or something. Also, a secondary objective is to help the client improve their accounting and internal control system. So while an audit is going on, there are different tests that are conducted in an audit. There's test of control, test of details. We look more into that as we go ahead in this study. But then eventually, when the audit is conducted, there will be some adjustments to the financial statement. There will be recommendations in the form of management letter, or you need to adjust on this. This is not properly classified, so we have to reclassify this particular transaction, or this is not done in line with the international financial reporting standard, and this has to be adjusted. So eventually, when the audit is conducted, the clients end up having a better accounting system because of all these recommendations that the auditors will give them. at the end of their job. But that is not the primary objective of an auditor. It just happens as part of the audit process. So the general principles of audit. An auditor should comply with the code of ethics for members issued by the International Federation of Accountants, aka IFAC, IFAC. So anywhere you see IFAC, that is the International Federation of Accountants. So the ethical principles governing the auditor's professional responsibilities are independence. Now, what does it mean to be independent? Okay, what does it mean to be independent? So to be independent means that you are free from bias, you are free from pressures, you are not influenced, you are not unduly influenced by the director. So you are expected to be independent enough to make objective observation, enough to carry out objective audit procedures, enough to ask enough to be confident enough to ask for the evidence or documentation that you need to conduct your job. You're not afraid to ask for what you need. You're not conflicted, because we'll look more into the things that affect independence as time goes on. But basically, you are free from bias, you are free from pressure. Integrity, you're expected to be honest when you are conducting your audit. You're not supposed to just do your job anyhow. Nobody's reviewing me. No, you have to be honest in your job. Objectivity is still related to independence as well. You're expected to think objectively. You're expected to look at things objectively. Oh, this financial statement, is it in line with the standard? If not, should it be corrected? Should we pass an adjustment? Should we reclassify? Should we do this? Should we do that? Then professional competence and due care. So you are expected to be a professional in the sense that you are expected to have the skills to conduct an audit. You are expected to know what audit is about. You are expected to know the auditing standard. You are expected to know the financial reporting standard. You are expected to be properly groomed as to how corporate governance works. You're expected to continue educating yourself, being up to date with developments in the industry. You're supposed to be aware of all these things like the Finance Act. You have to be aware of what's happening in the Finance Act, the adjustments that are currently ongoing in the accounting standards. You have to just be competent. You have to know what you are doing. Then confidentiality. So whatever information that you get from the client space has to be very confidential. You're not to share it to even your relative, you're not to share it with any friend, you're not to share it with any press, because those are the confidential information of the company, and they are providing it to you in trust, believing that you are a professional, and professionals don't give out confidential information about their clients. Professional behavior. So you are expected to act in a way that will not discredit the profession. For example, you are an auditor or you are a professional accountant, and then you are involved in social vices, or you are involved in um immoral acts, things like that. You are involved in things that will make people talk against the profession, or you are involved in fraud yourself. You are involved in maybe insider dealing. You are involved in things that are not proper, maybe criminal activities. Those are wrong. They are not in line with the professional behavior. You're expected to be a professional in all that you do. And technical standard, you're expected to be in the know of standards that affect the profession, audit and accounting standards. The scope of an audit. So when you hear the word scope, it's basically what something covers. What are the areas covered by a thing? But in this case, our subject matter is audit. So the scope of an audit is basically what an audit covers. So the scope of an audit refers to the audit procedures that are deemed necessary in the circumstances to achieve the objective of the audit. So when you get into an audit, before you can start carrying out audit procedures, first of all, there's something that is called the audit engagement. So the audit engagement is more like an agreement to the terms of the audit, saying that okay, it's between the client and the audit firm, saying that this is what we are going to cover, this is the scope of our audit. We are going to only examine the statement of financial position, showing the profit or loss, statement of cash flow, note to the equity, note to the account, showing the change in equity. We are not responsible for any additional information that you provide in the annual report, because an annual report does not only contain the financial statement. There are a lot of other either mandatory or voluntary report that the company provides, like their corporate social responsibility report. They provide a lot of reports in that annual report apart from the financial statement. So the scope in the audit engagement, in the engagement letter between the client and the auditor, now have to like specifically state that this is what we are covering in the audit. These are the areas that we are responsible for carrying out audit procedures on. These are the areas that we want to we are responsible. So that's the scope of an audit, and it varies from client to client. And that's even just like the um the general scope. Because when you get into the audit proper, when you get into the financial statement proper, the scope also you have to also determine the scope. But that won't be done by you, that will be done by the engagement partner or the audit senior and managers generally, depending on the nature of the client's business, depending on the um the conditions, or the circumstances at that time. That's why we said audit involves judgment, it involves expertise. The more experienced you are, the better you'll be at making the right judgment on the audit procedures to conduct, on the areas to focus on. What are the key areas to focus on? What do they think um deserves more attention compared to another one? What are the areas that you can overlook? Because auditing is not 100% test. We'll look more into that as we proceed. So the procedures required to conduct an audit in accordance with international standards on auditing, that's ISA, international standard on auditing, should be determined by the auditor, having regard to the requirement of the ISAs. So every ISA has objectives that has to be achieved, and also the procedures. So an auditor has to put that into consideration when he's auditing the financial statements. So having regards to the requirements of the ISAs, the relevant professional bodies, that is, we have the IFRS, ISAs, yes, legislation like our Finance Act that just came in 2020, that was effective 2020. So you have to put all of this into consideration. Regulations, for example, regulations that came in during the COVID-19 period, that a lot of companies got tax waivers. All these things affect the financial statement. All these things you hear in the news about, okay, this is how business should be done now. This is the rate you should apply. This is the amount of stamp duty. All these things affect what we are going to check or what we're going to consider during an audit. Regulations, and where appropriate, the terms of the audit engagement, as I said, and also reporting requirements. Who are they reporting to? It also determines the procedures that will be performed on the financial statement. Reasonable assurance. Reasonable assurance. So this is a key element that you need to really understand, that you need to take note of when it comes to an audit. But let's read through before I explain. So an audit is designed to provide the reasonable assurance that the financial statement taken as a whole, reasonable assurance that the financial statement taken as a whole, that is, you are evaluating the whole financial statement, not just you saying you want to provide assurance on only the statement of financial position, that or statement of or the profit or loss statement. No, financial statement as a whole are free from material misstatement. Now, reasonable assurance is a concept relating to the accumulation of audit evidence necessary for the auditor to conclude that there are no material misstatements in the financial statement taken as a whole. Reasonable assurance relates to the whole audit process. So let's evaluate this one first. It says the reasonable assurance is a concept relating to the accumulation of audit evidence necessary for the auditor to conclude. Necessary, the key word is necessary, because there are some audit procedures that may not be necessary based on the materiality. So materiality is a key word that you also need to know if you want to understand reasonable assurance. So how materiality works is when you're looking at a financial statement, or when you're looking at an item or an amount in the financial statement, you have to consider, will the misstatement of this particular amount affect the financial statement as a whole? For example, in a financial statement, they posted something as 100,000, and then when you evaluated the books, you realize that it's supposed to be maybe 1 million, or it's supposed to be 5 million, for instance, and they posted 1,000. Now, depending on the nature of the business as well. For example, if that 1 million is material to the financial to the owners of the business, if that 1 million is something, if it's significant, if it's of value, if it can change their decisions on the financial statement, then it becomes material. So you have to consider that if there's need for you to like state that in your management letter, or let it become an audit issue, let it affect your opinion on the financial statement. So that's what materiality is about, and you have to put that into consideration before you now say you are giving a reasonable assurance. You're not giving an absolute assurance, you're just giving a reasonable assurance based on the audit evidence that you thought was necessary for you to evaluate the financial statement that is free from material, not immaterial, that is free from material, significant misstatement, basically. So an auditor cannot obtain absolute assurance because, first of all, you are not doing absolute testing. You're not testing every amount in the general ledger. You're not testing every amount in the or every item significantly in the financial statement. It's usually based on judgment on if you consider this first. So if you don't get to test this area, well, this area is not a risk area. So risk is also a key word in audit, because that also informs your judgment on the testing to do on what is material and what is not material. So an auditor cannot obtain absolute assurance because there are inherent misstatements. There are misstatements that could occur as a result of just the nature of the business, or because the management does not have a good understanding of how some maybe posting is done, or how a financial reporting requirement is supposed to be done. Those are inherent or based on just the nature of the business. So these limitations result from factors such as the use of testing. That's the reason why we cannot have absolute assurance. We cannot give 100% assurance, or assurance that the financial statement is 100% okay, because we are not testing every item 100%. We are testing based on samples. We are using samples, and the samples is dependent on the materiality of financial of items, and also the materiality, the function of the risk. So there's a lot of things that are involved in the test that is actually conducted by an auditor. Now, another limitation as to why we cannot conduct an absolute assurance is that there's also inherent limitations of the internal control. For example, management can override controls. Now, let me give you an example of management overriding controls. When it comes to authorization and approval processes, okay, and a payment is supposed to be done now. There's supposed to be a document raised called the payment voucher. Now, it's on that payment voucher that this authorization is required to be done. So the payment voucher has a space for prepared by, authorized by, and also approved by. So it has to go through that authorization and approval process before any amount is actually disbursed, or any amount is actually transferred from the bank statement by the accountant. So now, if one of the management wants to make an expense, for instance, wants to purchase something, they can decide to say, okay, that's part of the overriding of control, which is wrong. They can say, okay, there's no need for payment voucher, or even the accountant said we don't want to even go through the proper process for that particular expense or that particular transaction. They just feel like the owner now. So if the owner doesn't want to sign it, what can you do? You can't do anything. Or sometimes the owners have access to the financial statement. What if they make a transfer without letting the accountant know? All these are inherent limitations that could actually happen um, in their internal control. That's the management overriding, that is saying, let's not do this thing just for some personal reasons, which is actually wrong because it's against the controls that have been set in place by the same management. So, and also collusion. So someone could connive against another person, which makes it difficult for an auditor to actually identify fraud. You have to be super experienced, yes, before you can actually identify fraud. And most times fraud just goes unnoticed because of this word collusion. When they agree, okay, let's do this transaction off the books, let's use this bank statement without linking it to the bank statement reflected in the financial statement. Okay, so you use that bank statement for transaction. So if they use that bank statement for transaction and it's not shown in the financial statement, you can't obviously get a record for that. You can't say you want to check the record of what you can't even see in the financial statement. So there can be a lot of collusions like that, which makes it difficult for you to now say I'm doing 100%, I'm giving 100% assurance, because there are some things that goes on underground that you may not be in the know of, and you may never get identified depending on how smart they are. Now, also there's the limitation that because of the fact that most audit evidence is persuasive and is not conclusive. The fact that I conducted a test on an item in a certain way doesn't mean that now I'm concluding that the result of my test is correct. Now there's likely, for example, let's say you're auditing a revenue now, for instance, and you know that you've done your tracing to bank statements, you've gotten some supporting documentations and all. But then you doing the job cannot say, okay, since I've checked my samples, they are fine. You cannot say that is now conclusive. You cannot result to a conclusion that the revenue is okay, because sometimes the things that you consider immaterial, all those small ones that you overlook because your sample may be based on big figures, material figures, of course, all those small ones you overlook, there could be errors, there could be fraud also in all those samples that you did not, the ones that you did not include in your samples. Yeah, so that's why you cannot say your audit evidence is conclusive, again, because it's also linked to the use of samples. Okay, so I think I would like to take questions at this point. Is there any question? Questions?
Okay, if you guys have questions, can you please type it in the chat or raise your hand? But since you are not much in here, I'll allow you to unmute your mic and ask your question. So Adebayo Bidemi, do you have any question? And Emmanuel Michael, do you have any question for the tutor at this point?
Questions, ask questions. It's part of the skills you need as an auditor, asking questions, asking the right questions. So asking questions are allowed, in fact, is legal, over legal in this class. So if you have questions, please ask.
Thank you very much. I understand everything you've been teaching.
Can you say your name? Like, let me get to know who I'm.
You can go ahead. It's very, very understandable. Thank you very much.
Okay, thank you. Thank you for that.
Okay, so Adebayo Bidemi, any questions or comments? Okay. You have to unmute your mic. If you are trying to talk, you have to unmute your mic, Bidemi, to speak. Okay, I don't know. Maybe he's having some issues. Or you can just type in your questions in the chat. All right. So you can continue, Titilope.
Okay. So now let's consider audit risk and materiality. Now remember that where we're coming from before, we're talking about reasonable assurance and the fact that we're using a lot of testing, and the testing is a function of judgment, function of materiality. So this is where we get to explain what that materiality is really about, and the level of, or what determines the level of audit procedures that we get to perform on a transaction or an item of financial statement, which is the risk. So risk and materiality are keywords that you cannot overlook when it comes to determining audit procedures, expressing your opinion, doing what auditors do, basically. I don't know why this is showing. Sorry. Okay, so I'll read through before I explain. The auditor obtains and evaluates audit evidence to obtain reasonable assurance. We have explained what reasonable assurance is. That's you giving opinion based on the audit procedures that you deemed necessary, considering the circumstance of the audit or the nature of the client's business. There's a lot of understanding that goes into that, a lot of judgment, which is very subjective. That's why we give reasonable assurance based on what I explained the last time.
Sorry, Titilope, a question came in from Adebayo Bidemi. He said, please, can you explain the last limitations?
Let me go back. The last one.
Yes, the last limitations.
Okay. Yes. So I explained that, okay, it says the fact that most audit evidence is persuasive rather than conclusive. Now you receiving, okay, let me say in different angles. First of all, you requesting a documentation and them giving you the documentation doesn't mean that it is 100% accurate, because they can as well give you a document that is in line with what they have provided in the financial statement. Anything is possible. That's one. And then second of all, the fact that you conducted a test on a sample doesn't mean that the other items that you conducted, that you did not conduct a test on, are free from material misstatement. So those because of those, you can't conclude. It's not conclusive. You can't conclude that based on the evidence I obtained on those samples, I'm going to give 100% assurance that the financial statement is free from material statement. It's not conclusive, because somebody will still evaluate what you've done and feel like you didn't do enough. Like when you take it to your manager or your partner, there's a possibility of further audit procedures on that same thing that you've done and said that was okay. And even after the audit is concluded, if anybody reviews it again, there will still be need for audit procedure. So you can't conclude that based on the testing that I've done, the financial statement is okay. No, it is not conclusive. It's just at that point that it is persuasive that, okay, based on my opinion, based on what I've done, it is subjective, based on the test I've conducted, that I deemed necessary, that I thought is necessary, or that I think is necessary based on the circumstances, based on the nature, based on my observation. I'm now saying that I'm now giving my opinion. I'm expressing an opinion. Now remember, there's a difference between opinion and fact. Opinion is based on judgment, it's subjective. I'm giving you an opinion. So it's not something that you now say, I expect the books to be 100% okay. No. It is an opinion, because in the first case, all my tests are based on samples. My tests and the evidence I've got are not conclusive. I'm just persuaded that I've done enough tests that I deem was necessary. Do you understand? That's why we have this limitation. It is not conclusive, it is persuasive based on judgment. Are we clear? Hello? Hello?
Yeah, we are with you.
Are we clear now? Person.
I'm sure
What's
it's
his name?
yeah, I'm sure it's clear. Kindly continue, please.
I think confirmed that it's clear.
I think maybe he has a technical problem, so we will join back later.
Okay. Um, okay, so we're looking at audit risk and materiality because it informs a lot of the procedures. It informs the procedures that we are going to take. So the auditor obtains and evaluates all the evidence to obtain reasonable assurance. We've explained that about whether the financial statement give a true and fair view. We'll look more into that in audit reports. And are presented fairly in all material respects, which is what we're looking at, materiality, in accordance with the applicable financial reporting framework, which is IFRS. The concept of reasonable assurance acknowledges that there's a risk that the audit opinion is inappropriate. The concept of reasonable assurance acknowledges that there's a risk that the audit opinion is inappropriate because, as we explained, is subjective, it is not conclusive, we're using a lot of samples, and it's just testing that is involved, right? The risk that the auditor expresses an opinion, an inappropriate audit opinion, when the financial statements are materially misstated is known as audit risk. So audit risk is the risk that you as an auditor could give an inappropriate opinion that the financial statement shows a true and fair view. And this is also because audit is subjective, audit is done, a lot of sampling is involved in auditing. So a lot of things could um, go on that you may not be in the know of. So that now becomes an audit risk. The likelihood that you give an inappropriate opinion that the financial statement shows a true and fair view, that the financial statement is okay, when in fact it is not okay. So the auditor should plan and perform the audit to reduce audit risk to an acceptably low level that is consistent with the objective of an audit. Now, in every engagement, the auditors get to set their acceptable audit risk. They get to say that, okay, the risk level that I'm ready to accept that the financial statement may be materially misstated is mostly, generally, usually 5%. That's say that I'm saying that I'm giving maybe like a 95% assurance, but then that 5%, I'm like, this is the level of risk that I want to accept that the financial statement is materially misstated. Now, the level of risk, it could also be adjusted depending on the nature of the business, the circumstances, and how complex the organization is, or how material the transaction of that organization is to misstatement, things like that. So now the audit procedures that will be conducted now, or the level and the type of audit procedure that will be conducted will not be based on this audit risk, because if I want to reduce my audit risk, it means I have to do a lot more testing. We're going to look more into audit risk as time goes on, the control risk, the inherent risk, and then the audit risk. We'll look more into that as time goes on. But then it's the risk that determines the extent of audit procedures and the type of audit procedures that will be conducted on the financial statement. Now, the auditor reduces audit risk by designing and performing audit procedures to obtain sufficient, appropriate audit evidence to be able to draw reasonable conclusions. Keyword: reasonable conclusions, sufficient, appropriate audit evidence on which to base an opinion. So after the auditor has already understood the client's business, environment, what could affect the client's business, the internal control, the weakness and all that, they will now sit down and now say, okay, this is the extent of risk that we can take on this audit, that we're going to give an inadequate opinion. Therefore, these are the audit procedures that we are now going to conduct so that we don't have a higher risk than that. Sorry. Reasonable assurance is obtained when the auditor has reduced audit risk to an low level, acceptably low level, not like the likelihood that you are going to give a wrong financial statement will be like 50%. Then why are they hiring you as an auditor in the first place? It means they're not doing your job. But you are there to ensure, at least reasonably, to a reasonable extent, and reasonable extent is a little bit significant. We can say 90% is reasonable. At least if I give you a job to do and you are doing it like maybe 90% okay or 95% okay, and maybe you made a mistake for just 5%, of course that's still reasonable. But if you are making mistake like 50% of the time, it means that there's a problem. It means that you're not doing your job. You don't know what you are doing. So the more an auditor is able to reduce his audit risk, the better and the more reliable his opinion is going to be on the financial statement. Responsibility for, yeah, hello.
Can I ask a question?
Yes, sure, you can.
Does it mean that audit risk is the chance or probability of damage to an audit firm as a result of the client giving out an audit opinion that is wrong?
Damage to an audit firm. Damage. I'm not sure I get that. And the client doesn't give an audit opinion. I don't understand. Can you reframe your question?
Oh, what I mean, I just want you to explain more on that audit risk.
Okay. So, okay, I'm just giving an overview. When we go deep into the audit, we get to see different type of risks and how this audit risk is reduced. But then you just have to know that an audit risk is a risk that an auditor will give an inappropriate audit opinion. Now, mind you, the reason why there's this possibility that the auditor will give an inappropriate opinion is because of, like we said, the limitations to the audit. The limitations, the fact that audit is subjective, the fact that audit is based on testing, the fact that your opinion itself is based on judgment, and the fact that your audit evidence is not conclusive, it is just persuasive because you deemed it, according to you or based on your judgment, you have conducted the necessary, keyword necessary, you have conducted the necessary audit procedures on that particular financial statement. So this audit risk is what people consider, the audit firm considers at the back end. It's not like they're going to go and tell the client that this is my audit risk. No, they do that as part of the planning process before they go into the audit proper. So while they are planning and they say, okay, this is the extent of risk that we can accept. And because this is the extent of risk that we can accept, and based on our understanding of this client's business, that the client's business is very complex, the client business is prone to misstatement. Okay, now let's be more stringent with our audit procedure. So we're going to perform extensive substantive procedure. We'll look at that later. We're going to perform extensive checking of documentation. We're going to perform extensive maybe external confirmation. We're not going to rely so much on what they are telling us. There are a lot of things that goes into that decision. There are a lot of things that goes into like determining audit procedures. But then the audit risk is at the heart of that decision.
All right, thank you very much. It's well understood now.
Yes. So all these things will just be like, they're easily understood when you like get an audit job, because you see a lot of this. You see a lot of this being done because you'll be having meetings with your manager, you'll be intimated with the audit procedures, the assertions. A lot of things are just involved. But then just have a good understanding of how it works. Are we clear?
Okay, thank you very much.
Yeah, welcome. Okay, responsibility for financial statement. Now, remember, an auditor is to express an opinion on the financial statement, and the financial statement is more like a stewardship report prepared by the directors to their shareholders or for their shareholders. So the responsibility for preparing the financial statement is solely on the management, is solely on the board of directors. Of course, they are not the ones that will, it's not the director, like the Oga Patapata director that will do the preparation, basically. It's the accountant and stuff. But then the responsibility, they are the one responsible for that financial statement. They're the one responsible for it. So while the auditor is responsible for forming and expressing an opinion on the financial statement, the responsibility for preparing and fairly presenting the financial statement in accordance with the applicable financial reporting framework is that of the management of the entity. So it is the company's responsibility, aka when we say company, we're talking about the management, because they're the ones that we are concerned about. Because if we're looking at the agency theory, we're looking at the shareholders and the management. So whatever component of the management, they are shared the management. Do you understand? The accountant are part of the management, people preparing financial statements, and people that are checking the internal auditors, all of them are part of the management, basically. So they are the one responsible for preparing and ensuring that the financial statement is in line with the appropriate standard, that's the International Financial Reporting Standard, that's the applicable financial reporting framework. Yes. So the responsibility for financial statement is solely on the management, it's not on the auditors. The auditors are just to express an opinion on that financial statement. So the audit of the financial statement does not relieve the management or those charged with governance of their responsibilities. And these things are clearly stated out in the audit report, so that whoever is speaking the audit report will have a sound understanding of the scope. Preparing financial statement is not part of the scope of the audit. The scope of the audit is just to express an opinion on the whole financial statement, that it is free from material misstatement. Okay. So advantages of audit. So audit is carried out to add credibility to the financial statement concerned and to assure stakeholders of the truth and the fairness of the statement. Keyword: credibility. And this is because of, as we explained, the agency theory, the fact that the shareholders are different from the management. So the shareholders need some confidence that the management are not cheating them. They need some confidence that the management have not stolen their money, that is, misappropriated their asset or misrepresented something in the report that they are presenting to them. That's why we as auditors are professionals as well, who will evaluate the financial statement to add credibility to it, so that the shareholders can now say, okay, let's rely on this financial statement because our auditors, who are professionals, have checked it and reached a conclusion, an opinion, not conclusion, keyword, reached an opinion that the financial statement can be relied upon. So that is what audit is about. Now, the issue reliable source of information, keyword, reliable source of information for banks and other financial institutions when it comes to assessing the strength of loan and overdraft um, um, applicants. Now, before any company can get loan from any financial institution, your audited financial statement will be requested upon. Not just financial statements, your audited, not just management account, your audited financial statement. And that's because auditing adds credibility to the financial statement. Because if there was no auditing in check, it means that the accountant can window dress the account depending on their objectives. So if they want to show that they are booming, that they have revenue, they can just shoot up their revenue, or they can try to understate, that is, reduce their expenses, depending on the objective. And which is why auditing comes in. And if you want to get any substantial amount of money from any organization or from any financial institution, they will definitely ask you for your audit report, your audited financial statement. Audited account, that's number 2. as adjusted for tax purposes, submitted to Internal Revenue Service, carry greater authority than unaudited account. First of all, is your audited account that you need for tax purposes, which will be also be submitted to the Internal Revenue Service. So there are a lot of advantages to this. What be advantages basically of audits is adding some weight, some credibility is the keyword, credibility to the financial statement, some authority compared to an unaudited account. Yeah. And also the presence of a qualified auditor is useful because of the variety of other capacity in which he is able to assist. In the case of a company, the auditor can offer taxation, information technology services, etc. Yes, because let's say now you are done. When you get done with your old ICAN and now you become a professional accountant and you go into auditing, it's not only on auditing that you're experienced on, because you are going to learn a lot more of other things. So you can also provide advisory services. Although as an auditor, you're not supposed to do that, because now we look at the structure of an audit firm as time goes on, because every audit firm has different departments. There's the auditing department, there's the advisory department, there's the tax department. So there's usually that separation so as to ensure independence. Independence again is the keyword in auditing. So yes, but then when it comes to a basic recommendations that auditors could give would just be done in the management letter. It's part of the auditing process. So when you're done your checking, you provide a management letter with the issues the issues that you've identified and the recommendations. But then not like you're going to give a a standalone advisory services as part of your audit. No, it's a different package. It's a different package on its own. Okay. Um, Disadvantages of audit. Number one, when we're looking at this disadvantage, we're talking about disadvantages to the client. Disadvantages to the client. So first of all, payment of audit fees. Audit fees, a client could consider an audit fee to be too much or unnecessary. There are a lot of people who feel like audit is actually not necessary. Although for a public limited liability company, that's a listed company is unavoidable. But for normal limited liability companies, now that the Finance Act has made it voluntary for you to audit your account, so most of them will actually not even want to do the audit because they feel like the amount is too much. Um, it's too much basically. So payment of audit fees, most of them are not comfortable with paying that audit fee because it adds to the expense of the company. And then there's also work disruption. So because you're auditing a client, first of all, they have to put most times, not even sometimes, audits always disrupt client activity because you are requesting for document, give me this document, the accountant has to provide the document for you, have to provide the files, has to explain how the filing is done, they have to put you through the whole system, they have to answer your internal control questionnaires, they have to provide representations as to their activities for the year, they have to give you time for pre-audit meeting. All these things affect, they disrupt the work of the client. That most of them are usually not so welcoming, depending on personality and maybe whatever they're trying to hide, or just them and the job that they have at hand, their own pressures and stuff. So they are not usually comfortable with all this because it disrupts their activity, requests, and they have to attend to you. If not, you say that there's a limitation of scope and you can't conduct your work properly without getting all this documentation. But then that also requires some time sacrifice from the client at their own end. And then okay, now limitations of an audit. So the auditors express an opinion, like I said, we've been emphasizing on opinion. This is not a fact, it's an opinion. They do not certify whether a set of accounts is completely correct or not. They're not giving absolute assurance. That's what that means. We're not saying that 100% of this thing is okay. No, we're giving you a reasonable assurance that okay, based on our judgment, we have done our own materiality check on this account. We have considered the material aspect and stuff, and now we're reaching an opinion. that the financial statement shows the true and fair view. So basically, they have to rely on our judgment, and judgment is subjective because it varies in terms of competence, it varies with experience, it varies with skills, it varies with exposure, a lot of things that comes with that judgment. That's why it's not you as an associate that will give an opinion. It's not even the senior, it's not even the manager. It has to be the managing partner that will give that opinion, that will sign on that opinion after everybody has done their work and reviews and stuff. So what is reasonable assurance? You look at that already in the last slide. Depends largely on what the user of financial statement expects from the auditor's report. Now, another consideration in when we're looking at the audit procedures to conduct is who exactly are the users of the financial statement. Yes, we know the major users are the shareholders, but then we have that in mind. We have their interest in mind. We have their interest in mind because they want the true and fair view. So we have that in mind when conducting the audit and determining the audit procedures, basically. So I need a 1 minute break. I want to take water.
Let's see. Let's see.
So any questions so far? Are we clear? Are we clear to this point?
Okay, let's see.
Yes, I'm here.
Okay, so if you guys have any questions, you can put it in the chat or raise your hand. So I'll call your names one by one since we are not much. Ademola Francis, do you have any questions? If you have any questions, you can unmute your mic and ask. Okay, no questions from Ademola Francis. Bessie Fumilayo, if you have any questions, kindly unmute your mic now and ask your question. Okay, no questions from Fumilayo.
Okay.
Mr. Emmanuel Michael, any questions from you? Okay, no questions from Mr. Emmanuel Michael also, so you can continue.
Okay, thank you. The expectation gap. Now, this is a very key aspect. This is something that you also need to understand because if you're not going through this class, most likely you also have this expectation gap as an individual. For a lot of people who are not educated on what an audit is about the scope, all this thing I'm telling you about judgment, subjective sampling, reasonable assurance, it's because you know. For someone who doesn't know and then maybe they see a financial statement and it's audited and maybe someone relies on the financial statement and maybe the business now crashes, they'll be like, but an auditor said that the financial statement is free from material misstatement. They will not understand that first of all, you're giving an opinion, second of all, it's a reasonable assurance, third of all, is a lot of subjective work and subjective testing that goes into that particular opinion. That's what creates the expectation gap already. So now, expectation gap is the difference between what an auditor actually does and what the public expects and what the public thinks, their thoughts, what they think an auditor do. Is the difference between what an auditor actually does and what the public think that they do. That's what creates the expectation gap. Because it's their thinking that that makes them, that creates that expectation in them that an audit opinion or a audit report certifies that the company is good, that the company will live long, that the company the company is not fraudulent. That is an expectation gap. The difference between what an auditor actually does and what the public thinks that they do. Two different things. So number one of the expectation gap is that they expect that the auditor, the auditor reports, that they expect that the auditors report to the directors of the company and not to the members. So they don't know that the audit report is directed towards the shareholders, or yes, directed primarily towards the shareholders and not the directors. So the auditors are not giving their report to the director for use. The auditor are giving their report primarily to the shareholders, although there are other stakeholders that rely on that opinion, like banks, like the government, like employees, because they want to know that this company is a going concern, or that my future is secured. They want to know that, they want to feel that sense of security that the business is not going to die anytime soon. There are other secondary stakeholders that rely on the financial statement, on the audited report. But the audited report is directed primarily, is prepared primarily for the shareholders. But a lot of people don't know that. So they misunderstand that. So a qualified audit report, another expectation gap is that they believe that a qualified audit opinion is more useful to those who appoint the auditors, that is the directors, than the unqualified report, which is because they do not understand that an unqualified report is even the best report, because it is certifying that the financial statement is free from material misstatements. And a qualified audit report is saying that there is an exception to this. There is something that we cannot certify that is properly done. There's a tip of a material misstatement or something in the financial statement. We're going to look more. Are you saying something?
No, sorry.
Okay. So we're going to look more into audit reports as time goes on. But these are things that most people don't understand. But you, as a professional, you have to understand it, that a qualified audit report means that there's a comma in the financial statement. It means that there's something in the financial statement that is not that is materially misstated. Yes, that is materially misstated. We'll look more into that when we're looking at audit reports. But the general public, or people who are not informed about all of this, believe that a qualified report is better than an unqualified report, which is actually the other way around. They also believe that the auditor's duty to detect fraud. Now remember, earlier we said that detecting and preventing fraud is not the primary responsibility of an auditor. An auditor may or may not detect a fraud, or see or identify, because an auditor may or may not find a fraud, depending on how control was there. And you can't can you hear me? Can anybody hear me? Can you hear me?
Yes, we can. We can. We can hear you.
Okay, so that's,
Yes, we can hear you.
so all right. Yeah, so those are expectation gaps. So it's not an auditor's duty to detect fraud. It is not an auditor's duty to detect fraud. The auditor's duty is just to express an opinion, and there are a lot of things that could go on, which is also what informs the audit risk. A lot of things could go on underneath that the auditor may not identify, because first of all, the auditor is not working inside there, and the auditor comes depending on the term of the engagement, of course, but then an auditor coming for a year-end audit, for instance, you are coming in January to audit a 12-month transaction, and then you don't even have up to 12 months to do the audit. So how are you supposed to know every tiny transaction, every tiny decision that has been made? But people do not understand that, right? So that also informs the expectation gap. And it's because of this expectation gap that there's been a lot of court cases against auditors. We look more into that as we progress into the audit. There's been a lot of court cases against auditors because other people who rely on the financial statement believe that they relied wrongly or the auditors were wrong, so they sue them, or that not knowing that the auditors are not primarily reporting to them, the auditors are primarily reporting to the shareholders. But a lot of these cases have been at least significantly reduced, although we had some cases last year with EY and was it PwC, although not in Nigeria, I think in UK or US, yeah, of them being dragged. They audited the client and then the client ended up folding up or something. So there were a lot of questions as to, but this thing was certified. There was an audit opinion that it was true and fair. There was an oversight from the conclusion. A lot of things went into that particular court case, but most times it's the expectation gap that actually informs all those court cases or a lot of misconceptions about auditors. But now, part of the ways an audit firm or auditors have tried to reduce this gap and therefore reducing the extent of cases against them is by educating whoever is reading the audit report. For example, in an audit report, there's a lot of explanation as to who's responsible for the financial statement, who's responsible for preparing financial statements, who's responsible for preventing fraud and errors, who's responsible for detecting fraud and errors. Those are the management responsibilities. So the management is responsible for preparing the financial statement, ensuring that the internal control system is effective enough to prevent and detect fraud and material misstatement. Those are the primary responsibilities of the management and not the auditor. So there's a lot of audit education. If you pick an audit report today, you are going to see a lot of these explanations, lots of explanations about who's responsible for what. This is our scope. We're not responsible for other aspects in the annual report apart from the audited financial statements. Expectation gap for you. So let's look at the structure of an audit firm, because a lot of us, I'm sure, we want to work in an audit firm. Auditing is actually very interesting, and I think almost everybody should try to get their legs into auditing, because it will open your mind to how companies operate, how different accounting system works, how financial standards are applied, because it's when you are analyzing all of these things that you begin to think, that you begin to go back to your standards. But you could be limited, or you may not be able to function properly as an accountant if you're not going through an audit process. Because if something is done in a certain way and you don't have experience as to how things are done elsewhere, or you don't have other experiences to challenge how those things are done, you just keep on continuing. And when auditors come, you feel like, but we've always been doing it this way now. Why are they coming to question, blah, blah, blah? But auditors are objective, as we said again, and they are there to ensure that the standards are being followed. And also, if you can get an audit firm, it's really nice. Okay, structure of an audit firm, how a proper audit firm is structured. Or basic, okay, let's just say these are basic structures, actually. So audit firms have structured management, although not all, but yeah, a structured audit firm has structured management. Let me paraphrase that. The partners generally delegate decisions of routine management to the senior partners. Someone is drawing something on my slide. Is anybody seeing this? What's going on? Mr. Ridwan, are you there?
Yes, I am trying to see what's happening. I think it's gone now.
There's still one stroke up. Okay, yeah, it's gone. It's gone. Okay, we're looking at structure of an audit firm. Okay. Audit firm have structured management. The partners generally delegate decisions. The routine management is senior partners. Okay, let me give an overview before I read this. So in a proper audit firm, you are going to have a managing partner, you are going to have a managing partner, audit partner, engagement partner. No. Managing partner, engagement partner, audit manager, audit senior, audit associate. These are the 5 things you're going to see in an audit firm. And the managing partner, engagement partner, audit manager, audit seniors, and an audit associate or other junior auditors. Yeah. So the partners delegate the routine management to the senior partners who reports to the okay, who reports to the full partnership at regular convening meetings. So the professional staff and partners maintain accurate time records. So when you are going for any job, there's something called timesheet, because the audit fee is based on the time, based on that timesheet. So the audit fee is based on the expected or the estimated time that the auditors will spend at the client place. And per the rate differs per who exactly is going for the audit. For example, if an audit senior is going for the audit, his rate will be different. Yes, he might spend maybe 120 hours or whatever cumulatively. That's the expectation for the audit. His rate will be higher than the rate of a junior auditor. The rate of the engagement partner will be higher, of course, than that of even the audit manager. So there's the engagement partner in every audit. There's an engagement partner, there's audit manager, there's the audit senior, and a junior auditor. Those are the 4, and their rates differ. The timing they're expected to spend on the job as well differs. So the professional staff and partner maintain accurate time records to ensure that all time assigned to client affairs are properly billed. So billing is on a timely basis, a bill on an hourly basis, yes. Because it's on time sheet you have, I spent 8 hours on this, I spent 4 hours, I spent blah blah on that. So assigned to client affairs are properly billed at the appropriate hourly rate, is an hourly billing, determined in turn by reference to salaries. In this way, the firm recovers salary costs or professional costs and overheads. The read one. Sorry, 1 minute, please. This thing is showing. Please move the window away from the shared application. I don't know. Are you seeing this or am I the one?
Okay, I'll try and resolve it now.
Okay. Okay. So the professional staff and partners maintain accurate time records to ensure that all the time assigned to client affairs are properly billed at the appropriate hourly rate, determined in turn by reference to salaries. Of course, okay, yes. Now, the audit firm receives payment based on the hours that different staff or different auditors, although to the audit firm they are staff, but to the clients they are auditors. The different auditors spend on the client's place, but the staff salary is not based on those hourly rates, so it's based on your agreed salary. And that's just so you know, just an agreed salary. So the difference now becomes the profit to the firm, basically. So the firm's revenue will be on that hourly basis that is now billed to the client, but the firm's overhead costs will not be your salary, your flat rate that you receive as an auditor. So the excess of audit fee over this cost represent partnership profit. So most audit firms are actually partners, usually a partnership kind of arrangement. Yeah, partnership kind of arrangement. Although when you do business management and finance, is in 11. Yeah, senior management and finance. You see how the big fours are sorry, the big fours are structured. I'm not sure it's on a partnership basis. I think it's on a network basis. You study that in your business management and finance. Let me see that. Okay, so partners are made responsible for the service given to a client. Each of them designed, okay, which each of them is designed assignment partner. So in real time, in real life, this is the engagement partner, not assignment partner. Sorry about that. Okay, so in the term is engagement partner, but the detailed management of each assignment is the work of a manager. Now remember, I told you the structure in every audit engagement. There's going to be an engagement partner. There's going to be an audit manager. There's going to be a senior. There's going to be a junior auditor, and all. So there's so based on this now, we're saying partners are responsible for the service to the client, which each of them is designed engagement partner. But the detailed management of each assignment is the responsibility of the audit managers, who in turn are responsible for managing the senior and the junior auditors. I hope that's clear. That's what you see in a proper, like in a structured audit firm. Although for a small audit firm where they are not so much, you find out that most times is the managing partner that is the engagement partner, and there's also the audit manager. So they are responsible for these three steps. And some firms have only the management partner, who in turn is the engagement partner and the audit manager. Then maybe the trainees, now maybe there'll be a senior trainee or and a junior trainee. Yeah, so but in a structured, in a proper audit firm like the big fours or even PKF, medium-sized audit firm, BDO, Pedabo, all those ones, you see things like this. This is like the proper structure of how every job should be or every audit should be. Types of audits. So we have private audit and we have statutory audit. So I would like to call the private audit voluntary audit, and then also the statutory audit. Now, a private audit, aka voluntary, is one undertaken at the instance of an interested party. That also gives it off as a voluntary audit. E.g., a sole trader, proprietor, one-man business, or partners of a partnership, even though there is no legal obligation that an audit should be carried out. So in terms of a private audit, the audit is not compulsory. There is no obligation for them to conduct that audit, but they decided to conduct the audit depending on their own objectives. Maybe they want to strengthen their financial system, and maybe they are looking at becoming public sometime soon, and they want to be sure that their records are in place, keeping themselves in check, ensuring that they are being honest to each other as partners, ensuring that they are okay for maybe getting a loan. Here, for those who want to get a loan, they have to go through the auditing process. They're ensuring that their books are okay to get a loan, to get grants, to get funding, to get support, whatever. So that is voluntary because it is not compulsory, it's not mandated on them to carry out that audit. In the case of a private audit, the scope of the audit may be determined as narrowly or as broadly as the client wishes. So because it's not a statutory audit, the auditor cannot impose a scope on them. They are the one that will say, okay, we want you to audit A, B, C, D for us, so that we can be sure that we are in check, we are showing the right thing, or we can get a loan or whatever, depending on the objective. Okay, depending on the objective, right? And then a statutory audit arises under the company law. Sorry. Company and allied matters act. So you see a lot of that under your corporate governance and ethics, I believe. Okay, statutory audit arises under the company law, as a result of which it is a statutory obligation. Now you're obliged to carry out this one for the account of every limited liability company to be audited annually by a professional qualified auditor. Now, because of the Finance Act, it's not all limited liability companies that should be audited. In fact, I think now it's voluntary for them. It's not compulsory anymore for limited liability companies to be audited based on the Finance Act. So, but for those who are listed, public limited liability company, it is very, 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 very compulsory. Very, very compulsory. And I think that decision came because not all limited liability companies really have the proper shareholder management division. Most of them are just like as an individual now, I can decide to open a company. In my mind, I have a company. It's a company actually. I can decide to open a company, and I'm the shareholder. I'm also the manager. You get. I'm not separating ownership from management. I'm not going to do all that. It's mostly this public limited liability company that have the separation, the actual proper separation of ownership from management, and they're of course the one that need the reports and stuff. Because if you look at a small limited liability company, if you are giving a report, you are giving the owner the report for himself. It's not as if he's a steward to somebody, he's a steward to himself. So I think they must have considered that and just felt like it was really unnecessary to make limited liability companies do the audit by force, because they're not really reporting to an actual shareholder with that separation from management. So, but for a for a public limited liability company, it's very, very compulsory because you have actual shareholders, you have actual agency theories at work there. So statutory audits have their scope largely determined by the governing legislation, which the client or the auditor has no authority to vary in any way. For example, when you are auditing a bank, for instance, you know they are not just considering IFRS. You also have to consider bank and other financial institution as, or let's say you are auditing an insurance company, you also have to consider the is in my income, yeah, the National Insurance Commission Act, yeah. You also have to consider that. So, and you have no you can't say I only want to do IFRS. I'm not going to consider the nine form. I'm not going to consider both here. No, it's out of your authority to determine your scope, basically. Um, despite the fact that the appointment of an auditor is a statutory requirement, the relationship between the company and the auditor is governed by a contract, aka audit engagement letter. Yeah, sorry, engagement letter, which has the term of the engagement. There has to be that contract before the audit even starts. Engagement letter has to be signed by both parties. Both parties have to sign the engagement letter before the audit begins, because it's a process whereby both of them understand their responsibilities and their duties. It has to be clearly stated out. So there's nothing vague. Everything has to be clearly stated out. So nobody's dragging somebody that you didn't do my work well, or you didn't cover this. All the stories and the stories I thought don't get into the audit. Okay, so we also have external and internal audits. External audit is where independent persons are brought in from outside an organization to review the accounts prepared by the management. Every statutory audit is an external audit because it is independent auditors coming from their audit firms to evaluate um the operations, or not operations, sorry, evaluate the financial statement of the client. So external is when an independent person are brought in from outside an organization to review the accounts prepared by the management. The definition and objective of audit stated earlier in this chapter relates to external audit. I've said that already. That relates to that. That's the statutory audit, which is our focus, basically. Now, internal audit is where an organization appoints a full-time staff to monitor and report on the running of the company's operation. So, in a properly structured company, there's expected to be an internal auditor. Now, the internal auditor is the one that will do the internal checking, basically something similar to what an external auditor would do, but not as detailed as what they would do. Not as detailed as what they would do. Their own is basically most times to just check that the operations are working properly. For example, most of the internal auditors are the ones that are involved in authorizing any transaction. So that the fact that they are authorizing means that they have checked. They're the ones responsible for checking all these transactions. Is the amount on the PV correct? Is it in line with the quotation, or is it in line with the invoice? Is it in line with what has been approved or what has been discussed? Is the amount correct? Is there any need to correct anything or to flag anything? So most times it's the internal auditors that are the authorizers, because they're the ones to check and say, okay, I've checked it now, I'm authorizing that this thing can go ahead for final approval before it is now being disbursed. So, and then the strength of an internal audit sometimes could make the first of all could make the internal control stronger. So that is to say that even as an internal auditor, there's a level of objectivity that an internal auditor too have to have, although it's not to the great extent as the external audit. But then there's a level of objectivity involved, because if you want to be reviewing what somebody has done, you have to also be objective enough to say, no, this is not properly done, this has to be adjusted, this has to be changed and stuff. Now, if an internal audit is strong, to a large extent, it can help reduce the audit risk because you can now rely to some extent on. We'll look more into that when we're talking about the audit approach and stuff. It's just very interesting, so look forward to that. So yes, internal audit is done internally, and they also have their internal audit reports that they give to the management, certifying that the system is working properly, etc. So at this point, do you have any questions for me? I think I'm done. Any question? I'm taking questions. Any question? Hello? Are we together? What's going on?
Okay. Hi, Titi. Do you want them to ask questions?
Yes, please.
Okay, so you guys can unmute your mic and ask questions. Ademola Francis, Bensi Funlayo, then Inoma Okole. Inoma Okole, I think you just joined the class and the class is almost coming to an end. So, but don't worry, if you missed a part of the class or the whole class, you can watch it on YouTube from either Monday or Tuesday. We are going to post it on our YouTube channel. So you can go there and watch it. And I also encourage you guys to join the Telegram group. That's where we post the link to the classes. Yes, and once you see the link, go ahead and register for the class before the time. And please always try and join the class at least 15 minutes before the time. At least 15 minutes before the time. So if you have any questions, you can unmute your mic and ask, or you can simply send it to the chat. So we're expecting your questions. Okay, it seems nobody has any question to ask.
No question.
So you guys, I'm going to send a poll to the group now. I want you guys to kindly fill it. So the question in the poll says, did you find the class educative and engaging? So please, Okay, somebody is asking a question.
Okay.
Okay, you guys can still go ahead and fill the poll, but somebody is asking a question. So can you see the question, Titi?
Yes, I can.
Okay, please, you can read it out and answer the question. Thank you.
Oh, okay. No, I can't see the question.
Yeah,
How
please
is it?
check the chat. It's posted for everybody to see it.
Okay.
Please check the chat. Yeah, so you guys, please go ahead and fill the survey. Nobody will know what the option you chose. So only one person has done that. I'm expecting the other people to also do that. Thank you. Okay, Titi, you can go ahead and do. You can go ahead and answer the question.
Okay, the chat. Why is the statutory audit not voluntary? Why is the statutory audit not voluntary anymore? Statutory audit has never been voluntary. Statutory, for you to do statutory, it means an obligation. It is not voluntary, it's compulsory. Or except I'm not getting your question properly. If you're asking about why statutory audit is now voluntary, I don't get, or why it's not compulsory for the private limited liability companies. Is that your question? Can you unmute? Let's ask your question on mute. Neoma Okoli.
Norma Okoli, can you unmute? Or are you satisfied with the answer? Okay. Oh, sorry. Let me unmute her. Okay. Okay, you can unmute now.
Okay. She was talking about, she made a statement where she said the statutory audit is not voluntary anymore. I didn't really understand that part.
Statutory audit is not voluntary. No. Statutory audit is not compulsory for limited liability companies again, based on the Finance Act. So limited liability companies were expected to carry out a statutory audit before, but because of this Finance Act that came into effect in February 2020, it's no more compulsory. It's no more compulsory for them to carry out that statutory audit. But for the public limited liability companies, it's very compulsory. Their standards not changed.
Yeah. Thank you.
You're welcome.
Okay, so
any other question?
Ademola Francis, you are also unmuted now, so you can ask your question.
Okay, good morning. Sorry, can you
Good morning. Yes, we can hear you.
Okay, please, I actually want to ask about the expectation gap in auditing. Can you, you were discussing about it earlier, but I don't really understand much about it. Can you please explain further?
Okay.
You said the expectation gap, if I can get you, say is different between the couple. I don't really get it. Can you please explain further? Yeah.
Sure. So an expectation gap, or the expectation gap, is the difference between what an auditor actually does and what the public thinks an auditor does. Are you clear? It's the difference between what an auditor actually does and what the users, let me not use public, and what the users of the financial statement think an auditor actually does. For example, and I gave instances of where the users believe that an audited report or an audit report meant that the business was okay, there was no fraud, there was no misstatement, the business is supposed to continue as a going concern, nothing should make the business crash maybe next year. But that is not our primary objective. Now, the primary objective of an audit is to express an opinion. And as we said, audit has the limitation of has limitations because it is subjective. We do a lot of sampling. We consider materiality, right?
Okay.
We consider materiality. We have our own audit risk. We have our own audit risk when it comes to audit as well. So and then because of that, we are giving a reasonable assurance, not an absolute assurance. But the expectation that people have of auditors is an absolute assurance. They believe that that audit report gives an absolute assurance that everything in the financial statement is okay, which is not what we are doing. Because remember, even the definition of an audit, our focus is on material misstatement. There are some misstatements that may not be material individually, and we may not even identify them individually, but then cumulatively, maybe we didn't consider them in the sample because we felt that they didn't meet our materiality threshold and they were not material. But then maybe cumulatively now they become an issue, maybe for the next year for the client, and the client has an issue. People will not think that the audit was not properly done because they don't understand that auditing is just you giving an opinion, and it is very, very subjective. An opinion and a reasonable, not absolute, a reasonable assurance. Reasonable assurance. So, are we saying?
Okay. Hello.
Yeah, me too.
Yeah, thank you for the explanation. And some of the things that also confuse the user of audit or public is using qualified for a bad audit and not qualified for a good audit. Why is it so? Like, because to a layman, to say qualify is like is good, but it's also that way around in audit.
Exactly. That's why
sometimes you even get confused. Why in school it get me confused? Like qualify, you say something is qualified and you say it's bad.
but
Why is it so? Why not use qualified to be good?
Okay, that's a fantastic question. So, and as we said, that's what informs the expectation gap because they do not understand. We're going to look more into this concept of qualified and unqualified under reporting, under audit report.
Okay.
Under audit report, yes. But now that's why you are going through this process to be a professional, to be competent, to be skilled, to have the knowledge which the users may not have. That's why there's that gap, because they don't understand that a qualified report is we saying that something is not stated truly, something that there's a material misstatement. That's what a qualified report does. That's just the term according to the international standard of auditing. I met it there. That's how they called it, and
Okay.
yeah. So a qualified report says that something is not presented fairly and truthfully, and is material, just so the users can know that there's a material misstatement somewhere, drawing their attention to that material misstatement. While an unqualified is the one where you get, okay, this financial statement present truly and fairly the position of the company. So yeah.
But I
So
hope
just
we still
understanding.
discuss more about this in
Yes, we
nearest.
will. We will under reporting. Yeah.
Okay.
Just so you have the understanding. So now you understand. I think I've closed that expectation gap in your mind as well.
Yes. Thank you.
Okay.
Thank you.
Any other question?
Okay, is there any other question you guys would like to ask before we bring this class to an end? Okay, so for the poll, okay. We've gotten all the results we need for the poll. So that will be all for today. So if you are going to be taking performance management is tomorrow, Sunday, the 24th of January, and it will be starting by 7:45 a.m. You guys be punctual. If you haven't registered yet for that class, you can go ahead and click the link we've sent earlier to you to register.
Hello. I hope the performance review will be available for some of us that may not be able to.
Yes, the video will be available.
I may start the lecture, but I won't finish because I have to be.
Okay, no problems. The recorded class will be available on our YouTube channel. So make sure you subscribe on the YouTube channel and turn on post notification.
Okay.
All right. Thank you, everybody. And we hope to see you tomorrow.
Thank you.
All right. Thank you, Titi. Have a lovely day. Bye.